What up, folks? What's up? What's up? Thanks for tapping in. Hope you're doing well. Want to touch base on a quick few things. Happy New Year for one. I had some videos queued up that I was gonna upload, but then they kind of faded past the first of the year and they started not timing up correctly with the information. You know what I mean? It was outdated at a certain point. So I'm like, you know what? I'm gonna skip those, come back strong with a new video for you guys. Today is January 12th. As many of you in the industry, in the mortgage industry, in the real estate industry, stock industry, financial industries, know, today they released the December's numbers for CPI, which is the index that follows inflation. So once again, third month in a row, inflation year over year is down, right? So it's still rising higher than the Federal Reserve would like. So they're still gonna push to get inflation further down or down further, but it is good news that the rate of inflation is decreasing. So in November, the rate of inflation was 7.1. In December, the rate of inflation was 6.5. The Fed's goal is to get it down to 2.5%. Or let me take that back. Sorry, their goal is to get it down to 2%. A lot of industry, commentators are saying that that's going to be really tough for them to do. But the Fed has remained consistent with their message that they're going to stick to raising interest rates until they feel like they need to stop. And when they do stop, they will probably hold interest rates where they are at a higher, tick for a strong period of time to make sure that they do actually have a good control on inflation. So what that means is that, at least this is my perspective. I'm not an expert on this stuff, but what I think this means is that we can expect that in the next Fed's meeting where they say how much they're going to raise interest rates, we can expect that they're probably going to raise rates 0.25%. The projection and the expectation from most of the commentators that I follow that I feel are pretty reasonable and logical is that in 2023 we'll see the Feds raise the rates a total of 0.75% on them at the maximum, right? So depending on how far and how fast inflation falls, they may actually stop raising rates after this next increase, right? So the next increase or the next Fed's meeting, people are expecting that they're going to either go up 0.5% or 0.25%. So with the new news that the inflation rate has continued to fall compared to year over year, we are expecting now that there might be a chance that they will only raise rates 0.25%. So in my industry, the mortgage industry, what we see is that when there is speculation of the Feds raising interest rates, it seems like lenders jump way out ahead of it and raise rates to consider the speculation as well as just kind of going high on the estimated side. So if the Feds are going to raise rates 0.25%, my thoughts, I don't know if this is 100% accurate, but from what I see, it seems like the lenders may go ahead and raise rates 0.75%. Right? Because it kind of gives them a buffer. They're able to increase profits. Therefore, they are like a little bit better hedged on, in the future if rates go up. And then when they do see the Fed's expecting to slow down on their increases, the lenders have the flexibility and have the ability to adjust down a little bit. And I think, and once again, I always say I think because this is my logic. I'm not 100% on this stuff, but I think it makes sense. Just like if you're a company and you're hearing, you provide food, right? Like you're a farmer and you're hearing that cost of your gasoline and cost of your feed for your animals is going to go up XYZ over the next year. You might, increase your prices, not only the amount that it's going to increase, but give yourself a little buffer and go a little bit higher so that you have wiggle room and you can create an additional buffer for yourself. That's the logic that makes sense for me if you're trying to actually survive long-term in any business. You say, okay, hey, I'm expecting it to go this much higher. Let me go up a little bit higher just to create my buffer and profit that'll give you that additional reserve that allows businesses to actually last through tough times and through times where you really don't know what the increases will be. So I say all that to say, I think that a lot of lenders have already baked in the rate increase expectations. So I'm thinking that we might have already seen the peak of interest rates I think the peak on paper was last summer, summer 2020, July 2020, July 2022. So I think that we should steadily see rates slightly decrease over this next year. Even if the Federal Reserve is expected to go up this 0.75 over the year, I would think that since that seems to be the cap, I would think that lenders will start to, as this year goes on, decrease their interest rates a little bit. But once again, this is something that you should watch different commentators. Subscribe to the Federal Reserve's YouTube channel and get information directly from them, and you'll have different different news channels or financial shows that just have different perspectives. Like when I watch YouTube commentators, it's like a lot of people that have specialized knowledge that are like for instance, Clear Value Tax, really informative person, and it seems like I think he is a licensed CPA, so his perspective is coming from like an education in the profession, operating as a professional, and it seems to be very logical information with not much just conjecture and opinion. It's obviously his opinion and his perspective, but it's like not rooted in doom and gloom or clickbait culture, right? So I take what he's saying, I look at Bloomberg, I'll watch Bloomberg Surveillance, where they're taking a lot of global information in and then coming out with their projection. Richard Fain is another YouTuber that sometimes kind of annoys me because it's a lot of doom and gloom, but then sometimes he has perspectives that I like and I appreciate, and I think that they are informative. So my point is that I take all this into consideration before I kind of really come up with my own opinion. And it's still probably not a fully informed opinion, but at the same time, I think it's better than if I were just my own feelings. It's really like trying to take in educated perspectives from throughout the industry, as well as my own experience, as well as what I see going on within my company. And then I'm like, okay, this is what I think makes sense going forward. So on the practical side for our industry, for mortgage originators, for real estate agents, what I think that means is that we're still going to have a very strong buyer market. There's going to be the majority of our volume this year will be purchase transactions, buyers that are looking to buy houses. I think that as the year goes on, as rates start to slightly decrease, you will obviously see an increase in refinance transactions, because it's going to lower the space between where people currently are and where they're comfortable with going as far as interest rates. A statistic I read not too long ago was that 95% of mortgages in the country, this might have been a few months ago, had an interest rate below 5%. And I'm sure a large portion of those interest rates were below 4% and below 3%, which made it to where when rates jumped significantly to where they are today and where they've been at over the last year, the refinance incentive was completely depleted for the vast majority of people. So there's going to be a pent-up demand where there's people that are looking to take cash out, people are looking to pay off debt, people looking to do home improvements that are waiting to refinance. So as that rate starts to trickle down, more of them are going to say, okay, I'm okay with a 5%, I'm okay with a 4.75, etc. And you're going to see increases in refinance volume. But overall, I think that you're still going to see that the majority of loans that are happening in our industry are going to be purchase transactions. And I think that realtors that are active in areas that there is still low inventory, I'm in California, I'm in Los Angeles area, there's still low inventory in these areas. There was just never enough inventory for the population as people started to want to purchase more. And same thing for the Bay Area. We're also licensed in Texas and Florida and Colorado, but I don't live in those areas, and we only have a few agents in those areas, so I'm not really well versed on property availability in those different areas. But that's really what's going to drive the purchase market. So for real estate agents in areas where there is a shortage of properties, I think that you'll still see that you're able to be active, making money, closing transactions throughout 2023. For people that are in areas where there is a vast inventory of properties, I think you may see a little bit of a slow or like a lull in production, just because of the fact that you are probably in an area where you're seeing property values decline a little bit more aggressively because of the fact that there's inventory. And when property values decline aggressively, you tend to have less people ready to sell at that time frame. But you may have more, buyers that are seeing property values dropping as an advantage for them. So, I think that overall you'll still see the purchase market active. For our loan officers, what that means is that you need to stay pushing and stay focused on creating valuable relationships, mainly with realtors, as well as other people within the industry. Something that I really tapped into recently was, or not me personally, but one of my agents brought this up to me, was not only going after real estate agents, but going after different service providers within our industry. So obviously you have title insurance reps, you have, home warranty. Home warranties are literally on almost every real estate purchase transaction. The seller side is almost gifting a warranty, a home warranty that protects your home against, different, maybe some appliances, roofing, plumbing, things like that, but they're gifting that to the buyer. And there's always a rep associated with that. So, the rep at First American Warranty, or the rep at American Home Shield. These are a couple of the different home warranty companies, but these are the people that have connections with all these buyers. So when you speak to them, and you create a relationship with them where you're sending them people, and there's obviously not a quid pro quo scenario where it's like, hey, you send me this and I'll send you these. No, it's a relationship where you express your value, you let them know how you can help their potential clients or the clients that they've worked with, same way that you would with a real estate agent, and then that's how you end up being in the sphere of, I guess, like influence or sphere of acquaintance with these people, so that when something does come up, they're sending it to you because you're going to actually provide the service that they're looking for their client. So for my agents, I'm looking back at 2022, looking at who did well, who didn't do well, and the agents that shifted to focusing on creating relationships with realtors were the ones that did well. It was a pretty simple formula. The ones that focus on refinance transactions, their business pretty much came to a screeching halt, and they're just not active right now because they haven't shifted their mentality to creating the relationships, letting realtors know how they're valuable to their business, etc. So these are things that I've definitely touched on before, but going into 2023, if you're looking to have success in this industry, you got to tap into, creating relationships. One day there will be a time in the industry where, deals are falling in our laps again because of the fact that the rates are just, so good. People are just looking for, a way to refinance and lower their payments or take cash out. So that will happen again, but who knows when. So it's not a good concept, or it's not a good idea to kind of wait out and bank on that or hope that that's going to come back, because you can do better even in this current market by establishing relationships. And that's really what it is to be a professional, right? A lot of times I think we want to rely on technology so much. We want to buy leads and just like potentially call one of these leads and hopefully get a deal. But what you'll find is that leads work well in good times in the industry, because leads are already, you're looking at ratios of 1 to 2% when you're buying internet leads per se, right? When you're buying a contact from someone that's gone online and, just put out information to the industry saying, hey, I'm interested in this, very light touch. It's not like they've filled out, tons of information. They've put out some basic information showing a little interest, and the next thing you know, their phones are getting blown up. So that's not really like an attractive process for the client, and it doesn't really lead to high results for most agents, So just think about it. If you buy 100 leads and 50 of those are, a lot of times not good leads because the number doesn't connect or the person never picks up or whatever the case is, you're only expected to close 1 to 2% out of the actual leads. So considering all the ones that don't connect, the ones that have bad phone numbers, the ones that said they didn't apply, you can't really consider those in your 100 out of, like when you're trying to come up with your percentages. So not to say that leads don't work. Leads will work if you set up a system, you pound the phones, you really put in the effort and the energy, they will work. per lead, there's a system that will work for that lead. But the real way to create valuable relationships that will, you know, what's the word? The gift that keeps on giving. When you create that valuable relationship with a real estate agent, you know, these are people that you're going to end up staying in contact with for years, because when a client pops up that's looking for a home and they need to be pre-approved, and they know that you're the person that approves them quickly and is accurate and able to actually get the transaction done once it's, you know, gone into escrow, trust me, those relationships will be fruitful. But it starts with the upfront of going out, meeting those real estate agents, finding out who's active, staying in the faces of the ones that are active, figuring out a drip system to stay communicating with the agents that are new or becoming active, you know, and really figuring out where to put your time and water that, nurture that. Where you put water, your grass will remain green, right? Like where you put in your effort and energy, those relationships, those seeds that you planted will grow. So the main thing I've been talking to my agents about going into 2023 is consistency. You know, we have something in our brain that's telling us the right thing to do in most scenarios in life, right? And then we have our habits that pull us away from things, or our good habits that push us towards things, or our personality quirks that, you know, lead us towards pleasure as opposed to lead us towards, you know, pain or struggle or grind. We have to overcome those things, and we have to beat out those sides of our personality that aren't supportive of our overall goals. Because, you know, there's certain things that I like to do where, you know, at night I want to just chill with wifey on the couch, watch some dumb TV, zone out. But in those moments, I'm not actually helping myself get towards the bigger goals that I have, right? In those moments, whether it's an hour, 30 minutes, 15 minutes, if you set up something that incrementally gets you towards your goal and you just create a consistency with that. I'm not saying don't relax, don't watch TV, don't do that. I'm just saying if you can, along with the things that you're gonna do, add in some consistency of some sort of activity that grows your business, that grows your footprint in your area, that keeps you in front of clients that you've worked with before. You know what I mean? So, for instance, my wife, and this is the last thing I'll touch on, but my wife is an attorney, and part of her, you know, her setup is that she doesn't do much litigation where she's in court talking to the judge and presenting cases. She is more of a research attorney, so she has to bill for the time that she works. So what that means is that if she's doing certain research, she's able to, you know, like if she starts that research at 8 a.m. and she finishes at 8:45, she's able to bill 45 minutes to their client for that time. And then when she's done with that, until she starts the next activity, she can't bill, you know, so they are only truly getting credit for actual work that's done. There's no downtime that she's going to get credit for. She has to be accurate with her billing. So we were talking, and, you know, their year just rolled around. She hit a certain amount of numbers. She has a goal to hit 100 more hours in this next, you know, billing cycle for the year of 2023. So, you know, when she's thinking about that, you know, that seems like a lot when you think of how hard it is already to build the minimum requirement. And now she's trying to go to the next level so she can increase her ability to get a bonus. So I was thinking to myself, I'm like, hey, look, if you look at it like, hey, I have to build 100 extra hours over this next year, that's a certain, you know, struggle. That's a certain grind based on what I already have to do to get to where, you know, my minimum requirement numbers, the extra 100, that's extra. I'm like, well, maybe you should break it down like this. If you did 15 minutes a day, every 4 days, that equals 1 hour, right? So if you have 52 weeks in a year, there you go. You figure out how to do an additional 52 hours by doing an extra 15 minutes a day for 4 days a week. Now, if you want to get your additional 100 hours, now that means that you should do, you know, 30 minutes a day or whatever the math is. But when you break it down like that, that's how you say, okay, you know what? Hey, instead of sitting down and watch TV tonight at 7 p.m., I'll sit down at 7:30. I'll do that additional 30 minutes of prospecting, or for her, billing, or for us reaching out to clients to say, hey, I hope all is well, let me know if you have any questions. Like if you set that up and you do that and you accumulate that over a 30-day period or over a year, you're going to see that you really increase your productivity by doing something little. So I'm going to leave you with that. I wish you great success in the year 2023. This is a special year because the number 23 for me has always been a special number because that's my birthday or that's my birth date. And the great Michael Jordan. There's a lot of, like, if you look up the number 23, there's a lot of weird little, coincidences that I like to overplay in my head to increase the value of that number to me. But either way, no matter if it's a special number to you or not, let's make this year a productive year, a year that we stick to our plan, a year that we are more consistent, a year that we are more dynamic, and a year that we lower our stress levels. Being disciplined, being organized, being consistent, that lowers your stress because you're handling all the different things that your smart brain has said you need to reach your goals. So as long as you're doing that, you're not going to have this internal battle of why didn't I do that? I need to make this adjustment. Just do it. Be consistent. Hold yourself accountable, and you'll see that by doing that, your results are they're gonna have to increase towards your goals. It has to. It's scientific. It doesn't. You can't do a certain activity over and over again and not have an impact. You can't go to the gym every 3 times a week, or even if it's 2 times a week over a year compared to previously. You weren't going. You can't do that and not see an actual impact, not see improvement. So understand that it's that easy for us to reach our goals and to have improvement and to chase that success and get closer to it and grab it. It's just as easy as being disciplined. One thing that I had written down a long time ago, if you picture your goals right here and then accomplishing your goals right here, the bridge between your goals and accomplishment is discipline. So picture that word discipline as your bridge, your goal, discipline, accomplishment. Be disciplined, be consistent, you'll get there. And I have to remind myself of that. Like when it's YouTube, I have a kid, I have a wife, I have a company, there's a lot of things going around, but the only way I'm gonna actually get to the goals that I have related to building content, building my channel, is by being consistent. I see the incremental growth that happens to the channel when I'm consistent with my videos. So the only thing to do is be consistent with it, make better content, be consistent with it, make better content, be consistent, make better, and stay on it. No way to fail if you stay on it. So cheers, 100 years, happy 2023. I'll see you guys.